Imagine a financial scenario where your wealth not only increases but also provides you with regular returns. Picture a world where your money works for you, generating passive income each month. That's the power of investing in good dividend-paying companies. But here's the catch: not all dividend-paying companies are created equal. It takes strategic analysis and thorough research to identify the gems among the crowd. Get ready to unlock the secrets to long-term financial success. This is the first video in the series about different ways to invest in stocks. If you haven't seen the others yet, I'll leave the links in the description so you can watch them later. First things first. What are dividends? Dividends are payments made by a corporation to its shareholders, usually in the form of cash or additional stock. They represent a portion of the company's profits that is distributed back to its investors. The dividend amount is usually shown as a percentage of the stock's price, known as dividend yield. This makes dividends an attractive feature for many investors, as they provide a way to earn a return on investment without having to sell shares. Think of it as a reward for investing in a company. By owning shares in a company, you become entitled to a share of its earnings, which are paid out in the form of dividends. Dividends play a crucial role in building wealth over the long term. By reinvesting the dividends received, you can accelerate the growth of your investment portfolio, thanks to the power of compounding. This means that the more dividends you reinvest, the more shares you own, and the more dividends you receive in the future. Dividends can provide a stable source of income, regardless of market conditions. In fact, dividends have historically accounted for a significant portion of total stock market returns. By focusing on companies with a strong track record of paying dividends, you can create a reliable stream of passive income for years to come. Investing in dividend-paying companies is a popular strategy among investors looking for steady income and long-term growth. But like any investment strategy, it comes with its own set of pros and cons. Let's dive in and explore both sides of the coin. Let's start with the benefits of investing in these companies. Regular income. One of the primary advantages of dividend-paying stocks is the steady income stream they provide. This can be particularly appealing for retirees or anyone looking to generate passive income. Unlike capital gains, which depend on stock prices increasing, dividends are based on the company's profits and paid out regularly, providing a more predictable cash flow. Compounding returns. When you reinvest your dividends, you purchase additional shares of the stock, which can lead to exponential growth over time. This is known as the power of compounding. By reinvesting dividends, you can accelerate the growth of your investment portfolio without adding more capital. Lower volatility. Dividend-paying stocks tend to be less volatile than their non-dividend-paying counterparts. This stability can provide a cushion during market downturns, as investors often flock to dividend-paying stocks for their perceived safety and steady income. Sign of financial health. Companies that consistently pay dividends are often financially stable and well-established. Regular dividend payments can signal that a company is generating sufficient profits and has a positive outlook on its future earnings. This can be reassuring for investors, indicating robust business operations and financial health. Now, let's discuss the potential downsides of investing in dividend-paying companies. Limited growth potential. While dividend-paying companies provide steady income, they might have less capital to reinvest in growth opportunities. Companies that pay out a large portion of their profits as dividends might miss out on expansion projects, acquisitions, or research and development. This can limit their future growth potential compared to companies that reinvest their earnings into the business. Dividend cuts. During economic downturns or financial struggles, companies might reduce or eliminate their dividend payments to conserve cash. This can significantly impact your income stream, especially if you rely heavily on dividend income. A dividend cut can also signal underlying problems within the company, potentially leading to a decline in stock price. Tax implications. Dividend income is often subject to taxation, which can reduce your overall return. In some countries, dividends are taxed at a higher rate than capital gains, making them less tax efficient. It's important to consider the tax implications of dividend income in your investment strategy and consult with a tax advisor to optimize your tax situation. Income dependence. Relying too much on dividend income can lead to financial strain if those dividends are cut or if the stock's value declines. Diversifying your income sources and not solely depending on dividends can help mitigate this risk. It's essential to maintain a balanced portfolio that aligns with your financial goals and risk tolerance. Now that you know the pros and cons about investing in dividend stocks, let's find out what to look for when selecting the right companies. Selecting the right dividend stock involves several key factors. Let's go through the more important to guide your selection process. Consistent payments. First, look for companies that have a history of consistently paying and increasing dividends over time. This indicates financial stability and a commitment to returning value to shareholders. Check out companies in the Dividend Aristocrats or Dividend Kings lists. Payout ratio. Consider the payout ratio, which is the percentage of earnings paid out as dividends. A payout ratio under 60% is generally considered sustainable, as it indicates the company retains enough earnings to reinvest in growth while still rewarding shareholders. Business model. Examine the company's business model and industry position. Strong and stable companies in sectors like utilities, consumer goods, and healthcare tend to be reliable dividend payers. These industries are less sensitive to economic cycles, ensuring more predictable revenue and dividend payments. Dividend yield. Another important factor is the dividend yield, which is the annual dividend payment divided by the stock price. A higher yield can provide more immediate income, but it's important to balance yield with the other factors mentioned to ensure sustainability and growth. By focusing on these key factors, you can build a portfolio of dividend-paying stocks that not only provides regular income but also grows over time. While a high dividend yield is often what investors seek most, it should not be the sole criterion. Though it's an important aspect of this investment style, it is better used as an initial screening alongside other value factors. Let's go through some examples of companies that have paid good dividends over time and also presented a decent growth in its share price. Coca-Cola has a history of consistent and growing dividends, as well as a steadily growing share price. Johnson & Johnson presents a similar pattern, growing dividends and growing shares value with small volatility. IBM also has a growing dividend, although with a wider range in its share price. Key takeaways. Before we wrap up, let's recap the key takeaways. Regular income stream. Dividend-paying stocks provide a steady and predictable income, making them a great choice for those looking for regular cash flow. Compounding returns. Reinvesting dividends can significantly boost your portfolio's growth over time through the power of compounding. Lower volatility. These stocks are generally more stable and less volatile, providing a cushion during market downturns. Limited growth potential. However, high dividend payments can limit the company's ability to reinvest in growth opportunities. Risk of dividend cuts. Companies might reduce or eliminate dividends during tough economic times, impacting your income stream. Tax implications. Dividend income can be taxed at a higher rate than capital gains, affecting your overall returns. Diversification is key. Don't rely solely on dividends. Ensure your portfolio is well diversified to mitigate risks. And finally, maintain a long-term perspective. Dividend investing is not about quick gains, but building wealth over time. Patience and consistency are crucial. Remember, the market will have ups and downs, but a well-diversified portfolio with a solid strategy can weather the storms and grow steadily. Now take a look at this next screen where I'll be leaving other videos with great investment strategies you can use to grow your wealth substantially. Check it out. See you in the next video.